Our final method to discuss for the valuation of assets is fair value accounting. And it has the distinction, along with historical cost, of being the only method that is supported by the IFRS, and it's also supported by the USA GAAP. So let me just recap that. Historical cost and fair value accounting are the only valuation methods currently supported by the international accounting standards. So IFRS, represented here by AASB 13, defines fair value as the price that would be received to sell an asset, or what you would pay to transfer a liability in an orderly transaction between market participants at the measurement date. So there's some important points to note there. The orderly transaction means that it's a normal, regular transaction and not a forced or rushed sale. Market participants assume that the buyer and seller are at arm's length, and this is a regular transaction. So there's no collusion and no sweetheart deals, no mates rates. So for this to work, really, to value an asset under fair value, you need an active market in that asset. However, fair value accounting does allow for a series of measurement models. And these measurement models, there are three models that fall into two types. The first two measurement models that we'll see on the next slide are mark-to-market techniques. And this is what you use if the asset is represented by an observable market that has prices that are quoted publicly. And the first one that comes to mind with this is the share market. The second model is mark-to-model techniques for assets that don't have an active model and don't have publicly available prices. So for these assets, fair value accounting allows you to use accepted modelling techniques that usually involve present values and cash flows. So fair value accounting allows three levels, and this is in order of from number one is the preferred one, and number three is the least preferred. And the preference comes from objectivity. So level one, being the most reliable source of fair value, the imports into your measurement model come directly from publicly quoted prices, such as in the share market, for example. Level two, again, these are quite reliable. The value inputs to your value calculation are observable, but they're coming from similar assets, not exact assets. So, for example, if you're trying to value your motor vehicle fleet, you might go to publicly available lists of valuations, standard valuations for those motor vehicles. Level three is the least preferable, but still allowed, that uses models to adjust for risk and to calculate a likely value. So the accountant has a lot of options available when using fair value. So fair value offers more scope for valuing assets, and it's supported by international accounting standards, and it's supported in the USA as well. However, fair value pays much less attention to the effectiveness of management or the stewardship perspective. It is far more concerned with providing decision usefulness in financial statements. And also, fair value accounting has been criticised because it can exacerbate declining values of assets at times when there's wildly fluctuating asset prices. And this occurred in the financial sector during the subprime crisis, when a lot of banks had had monetary instruments on their asset base. Not all of them were bad assets, but still their prices were being plunged lower because of the ratings in the market. However, such criticisms can be considered unfair because fair value accounting does allow you a number of models to choose from. So you don't have to use level 1 or level 2. So that's a quick rundown there of fair value, and that brings us to an end to our quick tour of different methods, different theories for measuring value. So I hope you found it interesting. Our textbook, which we use from Craig Deegan, offers a lot more discussion. So I hope that after watching these videos, the textbook will make a lot more sense for you. So good luck with that. Bye for now.